So today we will be discussing PFRS 17 insurance contracts. So this is actually a very new and quite complex standard with many new terms to learn. When I say new, I don't mean new as in bagong mga words. I meant new sa mga walang experience or hindi familiar sa insurance business or industry. So this PFRS is so complex that many affected entities are not finding it easy to implement. Actually, the effectivity of this standard has been delayed already. So to when? We will learn about that later. Actually, sa end ng itong training session, I will tell you when is the new effectivity of this very new standard. Because of the complexity as well as length and coverage of the new PFRS, I will just try to discuss with you at the very least the basics of this standard, meaning we will not be tackling the complete provisions of PFRS 17 kasi super haba talaga siya. Yung basics lang ng standard ang pag-uusapan natin because of limited time. Hindi enough ang 1.5 hours to discuss all the provisions of this new PFRS. And because yung basics lang ang pag-uusapan natin, I highly encourage you to read PFRS 17 yourselves on your own time to supplement what we will discuss today. So we have 4 training objectives for this session. So at the end of this training, I hope that you would have learned the objectives, scope, and effectivity of PFRS 17. Learn the key principles and terminology contained in PFRS 17. Learn the accounting treatment for insurance and reinsurance contract. And finally, you would have understood the rules for presenting insurance contracts in financial statements, as well as yung mga disclosure requirements. So the objectives of this standard is to establish the principles for the recognition, measurement, presentation, and disclosure of insurance contracts within the scope of PFRS 17, and to ensure that an entity provides relevant information that faithfully represents those contracts. These are the objectives of PFRS 17. I think they're both self-explanatory naman, so we will move on to the scope or coverage of the standard. An entity should apply PFRS 17 to insurance contracts, including reinsurance contracts it issues. It also applies to reinsurance contracts that entity holds, and investment contracts with discretionary participation features it issues, provided the entity also issues insurance contracts. So kung walang insurance na kasama yung investment contract, then it is not covered by PFRS 17. So for us to understand the requirements of PFRS 17, we will need to learn first the key terminology used in the standard, starting with each of these terms that we used here, itong tatlong to. And we will do that in a little while. In the meantime, let's continue discussing the scope of PFRS 17 first. Now, there are some contracts that meet the definition of an insurance contract but have as their primary purpose the provision of services for a fixed fee. Can these fixed fee contracts be included in the scope of PFRS 17? The answer is, for such contracts, although covered by PFRS 17, an entity may choose to apply PFRS 15 instead as long as these specified conditions are met. Ibig sabihin, lahat ng conditions na ito kailangan ma-meet bago mai-apply yung PFRS 15. Kung may isa na hindi na-meet, PFRS 17 pa rin ang dapat mag-apply. So the conditions are, the entity does not reflect an assessment of the risk associated with an individual customer in settling the price of the contract with that customer. So kaya nga fixed fee contract ang tawag sa kanya kasi hindi nagba-vary yung price based sa level ng risk. Another condition is that the contract compensates customers by providing a service rather than by making cash payments to the customer. So hindi pera ang binabayad ng entity but services. The final criterion is the insurance risk transferred by the contract arises primarily from the customer's use of service rather than from the uncertainty over the cost of those services. So meaning yung risk comes from the use of the services provided by the entity. A good example of this type of fixed fee service contract is a maintenance contract where the service provider is obligated to repair specified equipment after a malfunction. So for example, yung mga maintenance contracts ng building owners with elevator companies. Another example of a fixed fee service contract covers car breakdown services in which the provider is obliged to provide roadside assistance or car towing services. For example, yung Wheelers Club before. Not sure if it still exists, but I used to be a member of that club actually. So I used to pay an annual fixed fee to Wheelers Club to ensure that I get roadside or towing assistance in case masiraan yung car ko sa daan. So these types of fixed fee service contracts might meet the definition of insurance since the level of service and the obligation of the service provider depend on an uncertain future event. So in cases such as this, may choice yung entity to either use PFRS 15 in accounting for the insurance service or PFRS 17. And the entity may make the choice of PFRS contract by contract. So every contract kailangan niyang i-assess kung PFRS 15 bang gagamitin niya or PFRS 17. But please note that the choice for each contract is irrevocable. So once in-apply mo yung PFRS 15, for example, for a particular contract, hindi mo na pwedeng baguhin at i-apply yung PFRS 17 sa the same contract the following year. Let's say nag-renew, hindi mo na pwedeng baguhin yung accounting treatment or yung accounting standard na gagamitin mo for that particular contract. Some insurance contracts naman provide insurance coverage only, like most short-term non-life insurance contracts. Pero meron ding insurance contracts that contain one or more components that would be within the scope of another standard if they were separate contract. As we all know, maraming insurance policies ngayon ang may kabundle ng investment plans. Yung habang nagbabayad ka ng premium, ini-invest na rin ng insurance company portion ng premiums na binabayad mo sa mga equity securities. So while you are being insured, nag-earn rin ng income yung insurance policy mo. So aside from insurance contracts with investment component, other examples of insurance contracts with more than one component are those with embedded derivatives or with service component or a combination of investment and service components. Here are examples of these components na pwedeng kasama ng isang insurance contract. So, embedded derivatives. We discussed embedded derivatives briefly in another training session. So, examples of these are financial derivatives such as interest rate options or options linked to an equity index. For investment components, an example would be pure deposits such as financial instruments whereby an entity receives a specified sum and undertakes to repay that sum with interest. While service components naman may pertain to services other than insurance contracts services such as pension administration, risk management services, asset management, or custody services. So when a contract contains multiple components, like I just said in the previous slide, PFRS 17 requires an insurer to identify and separate these components in certain circumstances. Once ma-separate, those components must be accounted for under the relevant PFRS instead of under PFRS 17. Therefore, an insurer should follow these 3 steps. First, apply PFRS 9 to determine whether there is an embedded derivative to be separated, and if there is, account for that separate derivative. Second, separate from a host insurance contract an investment component if and only if that investment component is distinct. Remember, only if distinct yung investment component. We will discuss distinct and non-distinct investment component in a little bit. For now, just remember that the entity should apply PFRS 9 to account for the separated investment component. And finally, after performing steps A and B, separate any promises to transfer distinct non-insurance goods or services. Such promises should be accounted for under PFRS 15, which is revenue from contracts with customers. So after separating the described components, an entity should now apply PFRS 17 to all the remaining components of the host insurance contract. So after maalis yung mga distinct components, yung may iwan, of course, PFRS 17 na ang gagamiting accounting standard. This chart shows which standard applies to each of these components. So if the components are embedded derivatives that meet separation criteria, so yung green actually, or are distinct investment components, then such components should be accounted for under PFRS 9. Kapag naman yung component pertains to distinct goods and services except insurance contract services, then PFRS 15 ang mag-a-apply. And if the component pertains to a non-distinct investment component or yung contract pertains purely to an insurance component, then PFRS 17 will apply. As you can see by this chart, PFRS 17 makes a distinction between distinct and non-distinct components, which we will discuss next. So, importante yung distinct at non-distinct component, yung distinction na yon. Let's bring back this slide again, and let's take another look at letter B. Sabi rito, it's separate from a host insurance contract an investment component if and only if that investment component is distinct. The entity should then apply PFRS 9 to account for the separated investment component. The words if and only if means that voluntary separation of investment components which are not distinct is prohibited. Kapag lang distinct yung investment component, saka tayo nagse-separate from the host contract. So, come to think of it, mahirap naman talaga mag-separate ng components kung walang distinction yung components sa isa't isa, di ba? How do you distinguish a dissolved sugar na nasa water, for example? Mahirap, di ba? So, wala nang distinction na ginagawa. Basta tubig siya na matamis, yun na yun, tapos na. The same rin sa insurance contract na may kasamang investment components. Unless distinct yung investment component, then such component is not separated from the host insurance contract anymore. Pero kapag distinct siya, meaning pwedeng i-separate yung investment component, then dapat i-separate yung investment component. And then the investment component will be accounted for under PFRS 9, while yung host insurance contract will be accounted for under PFRS 17. So merong bifurcation na ginagawa. By the way, exceptions pa rin dito. May exceptions pa rin dito kasi let's say distinct yung investment component, pero kung yung investment contract naman has discretionary participation features or DPFs, then PFRS 17 pa rin ang standard na mag-a-apply sa kanya. Meaning hindi kailangang i-bifurcate or i-separate yung contract. Remember sa scope natin kanina, sabi natin kasama sa scope ng PFRS 17 ang investment contracts with DPFs or discretionary participation features. So, kasama siya sa scope kung yung investment is with DPFs. Kasama siya sa scope ng PFRS 17, I mean. So, ito na yon. Basically, ito yung scope natin kanina. So, if a separation is not required, ito yung investment contracts with DPFs. Pinapakita ko lang sa inyo yung scope kanina. Nakasama talaga yung investment contract with DPF sa scope ng PFRS 17. So let's talk about distinct investment component. To identify distinct investment component, we need to know their characteristics. So according to PFRS 17, the investment component is distinct if the investment component and the insurance component are not highly interrelated. Remember yung not highly. Take note of not highly interrelated. And if a contract with equivalent terms is sold or could be sold separately in the same market or the same jurisdiction, either by entities that issue insurance contracts or by other parties. Hindi natin or ng entity kailangang mag-undertake ng exhaustive search to identify whether an investment component is sold separately. Pero just because hindi kailangan ng exhaustive searching, hindi ibig sabihin na hindi na tayo magse-search or research. Dapat i-consider pa rin natin or ng entity lahat ng information na reasonably available to determine kung distinct yung investment component or not. Sabi sa first bullet point, the investment component and the insurance component are not highly interrelated. Although not highly interrelated ang binanggit dito, yung term na highly interrelated naman ang dinefine ng PFRS 17. Meaning yung opposite ang dinefine ng standard. So, I guess kapag hindi na-meet yung criteria or characteristics ng highly interrelated, then obviously, not highly interrelated yung insurance component and investment component ng contract. Anyway, according to PFRS 17, investment and insurance components are highly interrelated if the entity is unable to measure one component without considering the other. For example, if the value of one component varies according to the value of the other, then the entity should apply PFRS 17 to account for the combined investment and insurance company kasi highly interrelated sila. Also, an investment and insurance components are considered highly interrelated if the policyholder is unable to benefit from one component unless the other is also present. For example, if the lapse of or maturity of one component in a contract causes the lapse or maturity of the other, then the entity should apply PFRS 17 to account for the combined investment and insurance components. A specific example for this is when in a unit-linked contract, the death benefit is the difference between a fixed amount and the value of a deposit component. So in this case, the components could not be measured independently. So talagang hindi siya ma-distinguish, parang talagang halos nagme-merge na yung mga components na yon. Here's an illustrative example of how to identify whether a distinct investment component exists. So these are the facts of the case. An entity issues a life insurance contract with an account balance, meaning investment. The entity receives a premium of 1,000 pesos when the contract is issued. The account balance is increased annually by the voluntary amounts paid by the policyholder, increased or decreased by amounts calculated using the returns from specified assets, and decreased by fees charged by the entity. When I say the entity, ito yung insurer, ha? Baka kayo ma-confuse. The contract promises to pay the following: a death benefit of 5,000 pesos plus the amount of the account balance if the insured person dies during the coverage period, and the account balance if the contract is canceled. So, ibig sabihin walang charges for yung no surrender charges. So, let's analyze this fact. So, the existence of an investment product with equivalent terms indicates that the components may be distinct. So, this phrase here, essentially sinasabi niya merong na distinct yung account balance, meaning yung investment. However, if the right to death benefits provided by the insurance coverage either lapses or matures at the same time as the account balance, as what these facts imply, then the insurance and investment components are highly interrelated and are therefore not distinct. Consequently, the account balance in this case would not be separated from the insurance contract and would be accounted for under PFRS 17. So, yun yung letter B. Let's now, balikan natin yung letter A, which is apply PFRS 9 to determine whether there is an embedded derivative to be separated, and if there is, account for such derivative. So, if nasa embedded derivatives ulit tayo, balik tayo sa embedded derivatives. So, an entity applies PFRS 9 to determine when an embedded derivative is separated from the host insurance contract and to account for the separated embedded derivative. We will not discuss the accounting for embedded derivatives today in detail because we have already, as I said, conducted a separate training for derivatives before. So we will just review some basics as they relate to insurance contracts. And if you can recall from our previous training about derivatives, an embedded derivative is separated from the host insurance contract if and only if the following conditions are met. A separate instrument with the same terms as the embedded feature would meet the definition of a derivative. The hybrid contract is not measured at FBPL or fair value through profit and loss. If the combined contract is measured at FBPL, there is no need to separate the embedded feature because the hybrid contract is already accounted for similar to derivative. The economic characteristics and risks of the embedded feature are not closely related to the economic characteristics and risks of the host contract. So simply stated, the embedded derivative and the host contract are not closely related. We will not discuss each of these anymore since these were covered already in our hedging and derivative training session. Determining whether an embedded derivative is closely related to the host contract requires consideration of the nature of the host contract and the nature of the underlying of the derivative. When I say nature of the host contract, I mean it to be the economic characteristics and risks of the host contract. If the natures of both the underlying and the host contract are similar, then they are generally closely related. Having said that, an embedded derivative in an insurance contract is closely related to the host contract if it and the host insurance contract are so interdependent that an entity cannot measure the embedded derivative separately. So yung basic concept na hindi ma-separate, pareho pa din dun sa kaninang example natin, although hindi naman embedded derivative yung component. So here are two examples of embedded derivatives that may be found in an insurance contract. So benefits such as death benefits linked to equity prices or an equity index. We will have an illustrative example of this in a little while. Another example of a derivative that may be found in insurance contracts are guarantees of minimum annuity payments where the annuity payments are linked to investment returns or asset prices. So these are two examples. These two are examples ng derivative na dapat i-assess kung pwedeng ma-separate or not from the insurance contract. And by the way, for reference lang, ano bang annuity na nabanggit sa second bullet point? Annuity, for those not familiar with the term, is a fixed sum of money paid to the insured or beneficiary of the insurance every year and madalas binabayad siya for the rest of the life of the insured or ng beneficiary ng insurance contract. Yun ang annuity. So, as I said, ito yung example nung isang derivative na component ng insurance host contract. So, let's read the fact. A contract has a death benefit linked to equity prices or an equity index that is payable only on death or when annuity payments begin and not on surrender or maturity. So, what is the embedded derivative here and what is the host contract? Well, the embedded derivative here is the equity index or equity price link feature. And the host contract is the insurance annuity contract. So, hopefully, kung nag-guess kayo, tama ang sagot nyo. So, let's analyze if the embedded derivative can be separated in this example. Here, the equity index feature meets the definition of an insurance contract because the policyholder benefits only when the insurance event occurs, which is yung death or start ng annuity payments. Therefore, the derivative, which as I said earlier, is the equity link feature ng contract and the host insurance contract are interdependent. Accordingly, the embedded derivative is not required to be separated and accounted for under PFRS 9 but remains within the scope of PFRS 17. So after ma-separate yung mga components na dapat i-account using other standards, syempre, yung mga maiiwan would be accounted for under PFRS 17 na. Unlike sa manufacturing, for example, na ang recognition ng revenue is for every sale, sa insurance contracts, nire-recognize at minimeasure ang insurance contracts on a per group or portfolio basis. Hindi siya isa-isang contract. Hindi per contract ang recording sa insurance. PFRS 17 requires entities to identify portfolios of insurance contract. But I think for us to understand the requirements of PFRS 17, we will need to learn first the key terminology used for PFRS 17 because we will be using these terms all throughout this training session. Di ba sabi ko rin kanina na we will learn the key terminology sa PFRS 17. So let's start with the three terms we used kanina during our discussion of PFRS 17, of the scope of PFRS 17. These are insurance contracts, reinsurance contracts, and investment contracts with discretionary participation features or DPF. So insurance contract muna. Insurance contract is a contract under which one party, called the issuer, accepts significant insurance risk from another party, called the policyholder, by agreeing to compensate the policyholder if a specified uncertain future event, called the insured event, adversely affects the policyholder. I think we all know naman the common types of insurance contracts like life insurance, property insurance, accident, medical, fire insurance, car insurance, etc. I think alam naman natin kung ano ang isang insurance contract. Reinsurance contract, on the other hand, is an insurance contract issued by one entity called the reinsurer to compensate another entity for claims arising from one or more insurance contracts issued by that other entity or the underlying contracts. In other words, reinsurance is insurance of insurance. Because under reinsurance, one or more insurance companies agree to indemnify the risk partially or completely for the policy issued by another one or another insurance company. So reinsurance is a mechanism used by entities to lower their exposure to risks. For example, a company wanted to insure its newly constructed nuclear power plant for, let's say, 1 billion pesos and wanted insurer A to cover the insurance. But insurer A is not confident that it could afford to pay 1 billion pesos on its own if the risk for which the nuclear power plant is insured for occurs. Sa tingin ni insurer A, kaya lang niyang i-take the coverage would be around 700 million pesos. So what insurer A will do is to find another insurance company or companies like insurer B in this instance to insure the rest of the coverage, which is yung 300 million. So sasaluhin ni insurer B yung the rest of the coverage na gusto ni Gray B company. So that is reinsurance. The third type of transaction or contract under the scope of PFRS 17 is investment contract with discretionary participation features or DPFs. So an investment contract with discretionary participation features is a financial instrument that provides a particular investor with a contractual right to receive as a supplement to an amount not subject to the discretion of the issuer additional amounts that are expected to be a significant portion of the total contractual benefits, the timing or amount of which are contractually at the discretion of the issuer, and that are contractually based on the returns on a specified pool of contracts or specified type of contract, realized and or unrealized investment returns on a specified pool of assets held by the issuer, or the profit or loss of the entity or fund that issues the contract. So I would guess ito na yung pinaka-popular sa mga binebentang type of insurance nowadays. Ito yung insurance na may kasamang investments. So hindi ka lang insured, nag-earn pa ng income yung binabayad mong premium. So parang insurance and investments rolled into one yung policy na hawak mo. Mahaba lang yung definition but essentially ito yon. Let's also define insurance risk and portfolio of insurance contracts. Insurance risk is the risk other than financial risk transferred from the holders of a contract to the issuer. So examples of insurance risk include the risk of fire, earthquake, flood, losses, or kahit yung liability arising from when an insured is found responsible for causing bodily injury, death, or property damage to third parties. So yung third party liability insurance, kung meron kayong kotse, or meron kayong car, I think you would know this third party liability insurance na required ng government for every car owner. Next is yung definition ng portfolio of insurance contracts. So these are insurance contracts that are subject to similar risk and are managed together. So as I said earlier, PFRS 17 requires the recognition of insurance contracts not on a per contract basis, but based on portfolio of insurance contracts or group of contracts. Note that contracts within a product line would be expected to have similar risks and hence would be expected to be in the same portfolio if managed together. Let's take these two types of insurance contracts as examples: single premium fixed annuities and regular term life insurance contracts. These two types of insurance contracts would be expected to be in different portfolios because they cover different insurance risk. Yung annuity covers the risk of longevity dahil pag na-reach mo yung pag na-reach ng insured yung retirement age or period na dapat siyang magbayad ng premium, let's say 20 years, at buhay pa yung insured, then the insurance company would have to pay the insurance coverage. Whereas yung life insurance naman, risk of mortality ang insurance risk niya, so baliktad naman. Yung isa buhay, ito patay. Dahil kapag namatay yung insured, saka magbabayad yung insurer. So, hindi similar ang risk na kino-cover nitong dalawang contracts na to. So, lahat ng regular term insurance contracts will be in one portfolio and all single premium fixed annuities will be in another portfolio of insurance contracts. So, hindi naman ibig sabihin na pag grupo na lang siya basta-basta. May rules ang PFRS 17. Each portfolio of insurance contracts issued should be divided into a minimum of a group of contracts that are onerous at initial recognition, if any, a group of contracts that at initial recognition have no significant possibility of becoming onerous, if any, and a group of the remaining contracts in the portfolio, if any. So, here's a visual illustration of this. As you can see, each portfolio has at the very least the three subgroupings that I just showed you earlier. A group of contracts that are onerous at initial recognition, a group of contracts that at initial recognition have no significant possibility of becoming onerous, and a group of the remaining contracts in the portfolio. So let's talk about the elephant in the room, because twice siyang binanggit sa groupings ng portfolio of insurance contracts. So I'm sure nasa isip nyo rin yun. This word is onerous. What is an onerous contract ba? An onerous contract is an accounting term that refers to a contract that will cost a company more to fulfill than what the company will receive in return. So simply put, ito yung mga insurance contracts na sa umpisa pa lang, they have already been assessed na hindi sila magiging profitable. So actually, on initial recognition ng onerous contracts, nagre-recognize agad ng loss at liability yung insurance company for the determined net outflow. And based on this definition, we can discern na yung division of each portfolio into the three minimum required groupings of onerous, no significant possibility of becoming onerous, and other contracts are based on the profitability of the contract. So yun yung basis ng subgroupings profitability. As you can see on this illustrative diagram, identifying different portfolio of insurance contracts and dividing each portfolio into these three minimum groups on initial recording requires significant professional judgment using qualitative factors, quantitative factors, or a combination of those factors. For example, yung sa quantitative factor, I think I should not be too hard because may pricing mechanisms naman ng mga insurers, and although may uncertainty involved sa business ng insurance, I'm quite sure meron or may capability pa rin yung mga insurance companies to at the very least compute yung mga probabilities in the future. Alam naman nila yon, di ba? I'm sure alam nila na kaya nilang i-compute kung magkano ang magiging profit nila or kung magiging loss. They foresee na silang magbabayad eventually doon sa claim. Yung assessment ng qualitative factors on the other hand could be based sa characteristics ng policy holders. For example, sino ang more or less prone to make claims sa kanila? Sino ba ang mas madalas mag-claim? Would it be mga babae ba? Lalaki ba? Mga senior citizens ba? Yung mga millennials ba? Or baka yung mga taga Luzon more than mga taga Mindanao or Visayas? Yung mga doktor ba o yung mga construction workers? In other words, maraming pwedeng gamiting factors in determining the grouping of contracts. It's possible na ang gamitin basis for the qualitative factors would be, for example, gender, age, location, occupation ng policyholders, etc. Please also note that an entity is not permitted to include contracts issued more than 1 year apart in the same group. The standard also makes it very clear that hindi pwedeng hindi gawin yung pag-subdivide or subgroup ng contracts in each portfolio, especially yung identification ng onerous at no possibility of becoming onerous sa mga contracts. So, hindi pwedeng hindi gawin ito. Ibig sabihin, yung insurance company, hindi niya pwedeng sabihin, ayokong disaggregate na mga insurance contracts. Hindi niya pwedeng gawin yan because required yung disaggregation under PFRS 17. In fact, PFRS 17 states that if an entity has reasonable and supportable information to conclude that a set of contracts will all be in the same group, it may measure the set of contracts to determine if the contracts are onerous and assess the set of contracts to determine if the contracts have no significant possibility of becoming onerous subsequently. If the entity, on the other hand, does not have reasonable and supportable information to conclude that a set of contracts will all be in the same group, it shall determine the group to which contracts belong by considering individual contracts. So I think it's quite clear that this provision of PFRS 17 requires entities to assess and determine which of their contracts, whether individually or as set, are onerous and which are not possible of becoming onerous in the future. Pero how can entities or insurers identify onerous contracts? Well, generally, insurers will be able to identify contracts that are potentially onerous on initial recognition. This is because, just like anyone doing business, these insurers also usually price their insurance contracts in such a way na magkakaroon sila ng profit margin. Because why engage in business kung magpapalugi ka lang naman? Pero just like any business also, sometimes sinasadya or at least aware ang management na may possibility that the price of the insurance contract that they will issue will result to a loss eventually. For example, low pricing is used to promote the insurance product. So, ginagamit, mababa yung price ng insurance kasi just to promote it, para lang ma-introduce sa market. Or baka bago lang yung product, so mababa muna ang premium. Or baka para ma-entice or para maka-entice ng new customers. So, binababa muna nila yung product, yung insurance cost nila. Pwede rin naman na yung price is driven by the competition or baka regulated yung premium na pwedeng i-charge ng insurance company. But in any case, and what I'm trying to say is that in general, may way ang mga insurers to determine kung onerous or potential maging onerous ang isang contract sa inception pa lang. Alam nila yan. So after identifying contracts that are potentially onerous, an entity will need to identify those contracts or sets of contracts that are in fact onerous on initial recognition. So unang muna, potential lang titingnan nila, alin yung mga contracts na potentially onerous. Kapag na-identify na nila yon, then yun ang yung talagang onerous na, ihiwalay naman nila from the potential, yung talagang onerous na. So from the identified potentially onerous contracts, the entity has now to identify yung hindi lang potential but in fact onerous talaga. So here kailangan uli ng sound judgment kasi kailangan mong ihiwalay from the potentially onerous contracts yung onerous talaga. So this identification of onerous contracts in fact could really be challenging. For example, baka yung portfolio includes different underwriting practices that impact the profitability of individual contracts. Or baka yung individual contracts within a portfolio are priced differently from the standard tariff or pricing matrix used for the portfolio. Next is, baka naman yung contracts are marketed and sold through different distribution channels that impact the profitability of individual contracts. And contracts also have unique features. For example, different yung benefits na binibigay. So, mahirap mag-identify. Kung merong mga ganitong features yung mga contracts na ini-issue ng insurance company, mahihirapan silang may distinguish pa rin yung onerous from the potentially onerous na mga contracts. In many cases, an entity is likely to consider whether it has reasonable and supportable information to conclude that a set of contracts will all be in the same group in order to complete the assessment at a higher level than the individual contracts. If this information does not exist, then it will measure the contracts individually to conclude whether they are onerous on initial recognition. After mag-group and subgroup yung mga insurance contracts, we can now talk about recognition. So when should a group of insurance contract be recognized? So nasa accounting na tayo. An entity should recognize a group of insurance contracts it issues from the earliest of the following dates. Remember, earliest of the following dates. The beginning of the coverage period, the date when the first payment from a policyholder becomes due, and when the group becomes onerous. By the way, if there is no due date specified in the contract, then it is considered to be the date when the first payment is received from the policyholder. So kung kailan na-receive yung bayad from the policyholder, yun ang ginagamit for letter B. Also, a group of insurance contracts recognized in a reporting period only includes those contracts issued by the end of the reporting period. New contracts are added to the group in the subsequent reporting period in which the new contracts are recognized. So let's take a look at this illustrative example. So these are the facts of the case. Entity A issued this contract with these terms. The insurance coverage period of the insurance contract, the contract issued starts on June 1, 2021. The premium date will start on January 1, 2022. Assume that this is the only executed contract and thus represents already a whole group. When will the contract be initially recognized? So, sagutin natin. So, as I just said earlier, a group of contracts should be recognized at the earliest of the beginning of the coverage period, the date when the first payment from a policyholder becomes due, and when the group becomes onerous. So, given these facts, so in this case, the earliest date among the three would be the beginning of the coverage period. Therefore, the contract will be initially recognized on June 1, 2021. Here's another example. Entity A issued a contract with these terms. So, Entity A becomes a party to the insurance contract on June 1, 2021. Pero the coverage period of the insurance contract will only start the following year pa, which is on January 1, 2022, which is also the premium due date. So may 7 months na pagitan from when Entity A becomes a party to the insurance contract until the start of the coverage period ng insurance contract, which is June 2, 2021 through December 31, 2021. Again, assume that this is the only executed contract and thus represents already a whole group. When will the contract be initially recognized? So, ang dapat gawin between June 1, 2021 and December 31, 2021, which is the pre-coverage period, Entity A has to evaluate whether the group is onerous or not. If it is onerous, then Entity A will have to recognize the group on the date when the group becomes onerous, meaning magre-recognize na siya ng losses. If it is not onerous, then Entity A will have to recognize the group on January 1, 2022, which is the coverage and premium payment date. So, medyo madali na medyo mahirap kung hindi tayo familiar sa insurance accounting. Madaling intindihan, pero kung first time nating makikita to, baka ma-confuse tayo initially. So let's now discuss measurement. So tapos na yung recognition, now let's go to measurement. Now, there are two approaches na binigay yung PFRS 17. The general model and yung premium allocation approach. We will first discuss yung, actually we will only discuss yung general model. Yung premium allocation model, hindi natin siya i-discuss in detail, pero pag-uusapan natin kung ano yung premium allocation approach. Kasi yung general model, ito yung basically, ito yung basic na measurement rule ng PFRS 17, kaya ito ang i-discuss natin. On initial recognition, an entity should measure a group of contract at the total of the amount of fulfillment cash flows, or FCFs, and the contractual service margin representing an earned profit an entity will recognize as it provides service under the insurance contracts in the group. So, one is called FCF, yung isa is CSM. So, these are terms na we have to remember. So, again, nakita na naman natin yung term na FCF. If you remember, this term was mentioned earlier during our discussion of onerous contract. Hindi ko alam kung napansin nyo. So, but let me remind you lang of the definition of onerous contract. Balikan natin yung definition ng onerous contract. So, see the term. So, FCF is a term that we should really understand because obviously, it is very important when it comes to measurement of insurance contracts. So, let's discuss what FCF is, or fulfillment cash flows. Fulfillment cash flows is an explicit, unbiased, and probability-weighted estimate or expected value of the present value of the future cash flows, cash outflows, less the present value of the future cash inflows that will arise as the entity fulfills insurance contracts, including a risk adjustment for non-financial risk. Note that probability-weighted means that the cash flows is estimated by considering a full range of possible outcomes. So maraming scenarios, each with its own probabilities na kinoconsider yung insurer in estimating cash flows. For example, pwede silang mag-consider sa estimation ng cash flows nila for a property insurance na sasabihin nila na mayroong 25% probability of a superstorm happening during the last 6 months of the coverage period nung insurance contract. So pwedeng gano'n yung gagamitin nilang assumption. O kaya pwede rin nilang i-consider na may 10% probability na magkakasunog within the last 3 months of the coverage. So yung mga ganong klaseng probabilities. Ano yung mga probabilities na pwedeng mangyari in the future? So the starting point for an estimate of the cash flows is a range of scenarios that reflects the full range of outcome, and each scenario specifies the amount and timing of the cash flows for a particular outcome and the estimated probability of that outcome. So as you can see, highly complicated ang pagdetermine ng fulfillment cash flows. In fact, an expert or specialist is required to do this activity. Hindi to kaya ng simpleng accountants lang like us. So we will not, kasi nga maraming probabilities na kino-consider. So we will not discuss in detail yung pag-compute ng fulfillment cash flows because we are not experts on this matter. So, but anyway, let's break down the definition of fulfillment cash flows. So in any case, pag-usapan pa rin natin yung fulfillment cash flows, yung pag-compute niya hindi natin i-discuss in detail kasi nga kailangan dito ng mga experts sa pag-compute ng fulfillment cash flows. So based on its definition, fulfillment cash flows comprise of these three components. So ito yan, A, B, and C. So let's briefly discuss each of these components of the fulfillment cash flows, starting with yung letter A, which is the current estimates of future cash cash flows. PFRS 17 requires current estimates of expected cash flows of a group of insurance contracts to incorporate in an unbiased way all reasonable and supportable information available without undue cost or effort about the amount, timing, and uncertainty of those future cash flows. To do this, an entity shall estimate the expected value, which is the probability weighted mean of the full range of possible outcomes. So kapag nag-compute ng value ng contracts, which is done through the computation of future cash flows, dapat imputed sa cash flows lahat ng reasonable and unbiased assumptions saka lahat ng possible scenarios or outcomes. So hindi lang isang scenario, maraming scenario ang dapat niya na kino-consider. Hindi siya yung parang usual na pag nagba-budget tayo, 'di ba, nagfo-forecast ng sales. Yung ibang company sinasabi lang 5% increase in sales next year, ganun lang. So for insurance, iba, maraming scenario silang kino-consider. Next is reflect the perspective of the entity provided that the estimates of any relevant market variables are consistent with observable market prices for those variables. So the cash flow should be computed based on the perspective ng insurance, hindi ng policy holder. Another characteristics of the current estimates of expected cash flows is that they should be current. So the estimate should reflect conditions existing at the measurement date, including assumptions at that date about the future. So hindi pwedeng gamitin yung nangyari na in the past. And the fulfillment cash flows must be explicit. The entity should estimate the adjustment for non-financial risks separately from the other estimates. The current estimates of expected future cash flows should also include all the expected cash flows within the boundary of each contract within the group. So take note of this phrase here. This one, cash flows within the boundary of each contract. So based on the previous slide, I think we can discern that fulfillment cash flows represent cash flows within the boundary of an insurance contract. When I say boundary of insurance contract or insurance contract boundary, I meant those cash flows that relate directly to the fulfillment of the contract, including those cash flows for which the entity has discretion over the amount or timing. So ano-ano bang examples ng cash flows within the boundary of an insurance contract? So PFRS 17 provided these examples of cash inflows or cash flows within insurance contract boundary. Premiums from a policy holder and any additional cash flows that result from those premiums. I think we all know what premiums are. Claims and benefits, including reported claims not yet paid, incurred claims not yet reported, and expected future claims within the contract boundary. I think we all know also kung ano ang claims. Next is payments to or on behalf of a policyholder that vary depending on returns on underlying items. So yung mga interest on or investment income attributed to the policyholder are examples of this third bullet point. Another example of cash flows within contract boundary are the claim handling costs. So these are the costs that the entity will incur in investigating, processing, and resolving claims under existing insurance contracts, including legal and loss adjusters fees and internal costs of investigating claims and processing claim payments. So lahat ng na-incur nilang expenses related sa pag-process ng claims. So these examples of cash flows within contract boundary should be included in the computation of future cash flows from a group of contracts. There are a lot more examples given in PFRS 17, but I no longer included them here because I just want you to get an idea kung ano-ano ang mga halimbawa ng cash flows within contract boundary, which is a significant component in computing for the estimated cash flows within contract boundary. So let's now discuss the second component of fulfillment cash flows, which is an adjustment to reflect the time value of money and the financial risk associated with the future cash flows, incorporating different possible outcomes. So, ibig sabihin, once na ma-estimate natin yung future cash flows, kailangan siyang i-discount at i-measure at present value. So, kaya may sinasabing time value of money. The estimated present value of expected cash flows can be determined by, as I said earlier, establishing a range of scenarios that reflects the full range of possible outcomes in which each scenario specifies the amount and timing of the cash flows for a particular outcome and the estimated probability of the outcome. The cash flows in each scenario are then discounted and weighted by the estimated probability of that outcome to derive an expected present value. So these discount rates applied to the estimate of cash flows should reflect the time value of money, the characteristics of the cash flows, and the liquidity characteristics of the insurance contracts. Be consistent with observable market prices of those financial instruments whose cash flows characteristics are consistent with those of the insurance contracts, and exclude the effect of the factors that influence such observable market prices but do not affect the future cash flows of the insurance contracts. In other words, dapat yung discount rate na gagamitin sa cash flows should be consistent with the cash flows characteristics ng insurance contracts. So, hindi natin pwedeng gamitin without any reason. Let's say, yung prevailing lending rate sa mga bangko or yung T-bill rates. Pinag-aaralang mabuti ang discount rates na ginagamit sa pag-estimate ng cash flows ng insurance contracts. Simply put, hindi straightforward ang pag-determine ng discount rate when it comes to valuing insurance. So the final component of a fulfillment cash flow is an explicit risk adjustment for non-financial risk. This means that the present value of expected cash flows should be adjusted for non-financial risk. But what is the risk adjustment for non-financial risk? Risk adjustment for non-financial risk is the compensation an entity requires for bearing the uncertainty about the amount and timing of future cash flows arising from non-financial risk as the entity fulfills insurance contracts. So in other words, the risk adjustment for non-financial risks relate to risks arising from insurance contract other than financial risk. So ano ba ang non-financial risk? Non-financial risks are risk the outcome of which cannot be measured in monetary terms. Pero ano ba mga types of non-financial risks na covered by the risk adjustment? The risks covered by the risk adjustments for non-financial risk are insurance risk and other non-financial risks such as lapse risk and expense risk. So, sa insurance risk, this means that the risk adjustment for non-financial risk shall reflect all non-financial risks associated with the insurance contract. It shall not reflect the risks that do not arise from the insurance contract such as general operational risk. So, ini-exclude yung mga general operational risk. Ano ba example ng general operational risk? Credit risk is one. So, hindi ito kasama when computing for the risk adjustment. So, but having said this, let's go back to discussing fulfillment cash flows. As I have just said, the estimate of the present value of the future cash flows is adjusted to reflect the compensation that the entity requires for bearing the uncertainty about the amount and timing of future cash flows that arises from non-financial risk. In this regard, the risk adjustment for non-financial risk for insurance contracts measures the compensation that the entity would require to make it indifferent between fulfilling a liability that has a range of possible outcomes arising from non-financial risk and fulfilling a liability that will generate fixed cash flows with the same expected present value as the insurance contracts. Masabi ko lang, indifferent means okay pa o kaya pang ma-afford nung company. Meaning, pag nagbayad sa kanila sila, okay pa sa kanila yung ganong amount ng bayad. Yun ang indifferent. Yun ang ibig sabihin ng what would make the entity indifferent. So, let's take an example. The risk adjustment for non-financial risk would measure the compensation the entity would require to make it indifferent between fulfilling a liability that because of a non-financial risk has 50% probability of being 90 pesos and a 50% probability of being 110 pesos. So this is an example of fulfilling a liability that has a range of possible outcomes arising from non-financial risk. And fulfilling a liability that is fixed at 100 pesos. So ito naman yung example ng fulfilling a liability that will generate fixed cash flows with the same expected present value as the insurance contracts. So given these probabilities, let's say given these probabilities, magkano ang amount na okay lang sa insurer na bayaran? Please note that the standard did not specify the estimation techniques that need to be used to determine the risk adjustment for non-financial risk. The standard only provided certain characteristics of a risk adjustment for a non-financial risk. One example given was the less is known about the current estimate and its trend, the higher will be the risk adjustment for non-financial risk. Or another example given by the standard is risk with lower frequency and high severity will result in higher risk adjustments for non-financial risk than the risk with high frequency and low severity. So, hindi nagbigay ng talagang kung paano i-compute yung fulfillment cash flows or yung itong choices na to. Walang binigay na example, detailed example ang PFRS 17. Parang ano lang siya, very vague. Masyadong generalized. Generalized masyado yung discussion ng PFRS 17 when it comes to fulfillment cash flows. As you can see, this is another factor na dapat ini-impute sa calculation ng fulfillment cash flows. And fulfillment cash flows is only one of the factors considered in determining the initial measurement of a group of contracts. So, sa fulfillment cash flows pa lang, complicated na meron pang isa, di ba, yung sinabi natin kanina, contractual service margin. Kasama yun sa kailangang malaman in measuring a portfolio of insurance contracts. So again, on initial recognition, an entity should measure a group of contracts at the total of the amount of fulfillment cash flows and the contractual service margin or CSM. So, we have discussed yung FCF. So, ano na naman yung contractual service margin? Another new term na another mahirap ding maintindihan. So, a contractual service margin is a component of the carrying amount of the asset or liability for a group of insurance contracts representing the unearned profit the entity will recognize as it provides services under the insurance contracts in the group. So, the CSM represents the unearned profit of the group of insurance contracts that the entity will recognize as it provides service in the future. This is measured on initial recognition of a group insurance contracts at an amount that, unless the group of contracts is onerous, results in no income or expenses arising from the initial recognition of an amount for the fulfillment cash flows, the recognition at that date of any asset or liability recognized for acquisition cash flows, and any cash flows arising from the contract in the group at that date. So, ibig sabihin, sa initial recognition pa lang, yung amount ng CSM for a group of contract, unless onerous yung group na yun ng contract, should be equal to the total of A, B, and C, itong A, B, and C na nandito, para mag-zero at walang income or loss na ma-recognize. Here's an illustrative example in recognizing a group of insurance contracts. So let's read the facts together. An entity issues 100 insurance contracts with a coverage period of 3 years. The coverage period starts when the insurance contracts are issued. It is assumed for simplicity that no contract will lapse before the end of the coverage period. So lahat ng insurance contracts will continue next year. The entity expects to receive premiums of 900 pesos immediately after initial recognition. Therefore, the estimate of the present value of the future cash flows is also 900 pesos. The entity estimates the annual cash flows at the end of the year as follows. The annual cash outflows are 200 pesos for a total of 600 pesos for 3 years. The entity estimates the present value of the future cash flows to be 545 pesos using a discount rate of 5% a year that reflects the characteristics of those cash flows. The entity estimates the risk adjustment for non-financial risk on initial recognition as 120 pesos. So, yun yung estimated risk adjustment for non-financial risk. So, how are the insurance contracts going to be measured? Let's see. The measurement of the group of insurance contracts on initial recognition is as follows. So, ang first step is to get the net of the present value of future cash inflows and cash outflows. After makuha yung net cash inflow or outflow, the next step would be to combine it with the risk adjustment for non-financial risk. Yung makukuhang result dito would be the fulfillment cash flows. Note that PFRS 17 requires the fulfillment cash flows to comprise estimates of future cash flows adjusted to reflect the time value of money and the financial risk related to those future cash flows and a risk adjustment for non-financial risk. It can also be concluded that these insurance contracts on initial recognition are onerous because the fulfillment cash flows on initial recognition are a net outflow kasi negative, di ba? Applying paragraph 16A of PFRS 17, the entity A will have to group those contracts separately from contracts that are not onerous. The entity recognizes a loss in profit or loss for the net outflow, resulting in the carrying amount of the liability for the group being equal to the fulfillment cash flows and the contractual service margin of the group being zero. The entity should then measure the contractual service margin on initial recognition of a group of insurance contracts at an amount that results in no income or expense arising from the initial recognition of the fulfillment cash flows. Diba sabi natin kanina, dapat zero. Consequently, the contractual service margin equals 235 pesos para mag-zero. And finally, the entity will have to measure the group of insurance contracts on initial recognition at the total of the fulfillment cash flows and the contractual service margin, which in this case is zero. So, wala siyang i-recognize. Once ma-receive yung premium na 900, kasi yung kanina, yung palang yung ine-expect nilang premium na yung case kanina, ine-expect pa lang nila na ma-receive nila yung premium. Now, na-receive na nila yung premium. The carrying amount of the group of insurance contracts changes to this. Magiging ganito yung computation. If you will notice, nawala yung negative 900 pesos, di ba kanina 900 yan eh. Ayan na, 900 siya, di ba yung on top. Ngayon nawala na siya, which is the estimated, because this is the estimated present value, because yung kanina was the estimated present value of the future cash inflows, dahil wala pang ang receipt, ngayon na-receive na, so magiging zero siya. Pero the rest, lahat ng numbers na makikita nyo rito are the same with yung computation kanina. Same siya lahat, but of course, mag-change yung ilalim. Which is now yung asset and liability, kung kanina zero, subsequently, magkakaroon siya ng 900 pesos na liability. So that's the general model of recognizing and measuring a group of insurance contracts. But there's another model, a simplified one that can be used as well. So ito yung sinasabi ko kanina sa inyo, it is called the Premium Allocation Approach or PAA. So alternative lang to. So ang default na recognition is yung general model, which ito yung total ng fulfillment cash flow saka yung contractual service margin. And siya yung long cut basically ng pag-recognize ng revenue and assets and liabilities ng insurance contracts. But we will not discuss in detail anymore this premium allocation approach due to time limitation. Pero let's just briefly discuss kung ano ang PAA para lang magkaroon tayo ng idea. The premium allocation approach is an optional simplified form of measuring an eligible group of insurance contracts issued or insurance contracts held. An entity may simplify the measurement of the liability for remaining coverage of a group insurance contracts using the premium allocation approach on the condition that at the inception of the group, the entity reasonably expects that this will be a reasonable approximation of the general model, or the coverage period of each contract in the group is 1 year or less. So may mga conditions before magamit itong premium allocation approach, and these are those two conditions. So yung letter B, kapag 1 year or more yung period ng covered ng insurance contract, hindi pwedeng gamitin itong premium allocation approach kasi for less than 1 year na mga contract lang siya pwedeng magamit. Where at the inception of the group, an entity expects a significant variance in the fulfillment cash flows during the period before a claim is incurred, such contracts are not eligible also to apply the PAA. So that is PAA. Pag-usapan naman natin yung reinsurance contracts kasi nabanggit natin kanina na part siya ng scope ng PFRS 17. So let's just see kung anong differences between reinsurance contracts sa recognition and measurement ng reinsurance contracts and insurance contracts. Hindi rin natin siya i-discuss in detail. Titingnan lang natin yung mga differences between the two kasi ang pinag-usapan natin or what we discuss are those for insurance contracts. So ngayon tingnan lang natin kung reinsurance ba siya, anong difference with yung kung direct insurance contracts ang hawak natin. So, for the insurance contracts, the requirements of PFRS 17 are modified for insurance contracts, meaning yung measurement and recognition for insurance contracts have been modified or are modified for insurance contracts under PFRS 17. So, as I said, here's a comparison of when to recognize insurance contracts and reinsurance contracts. For the insurance contracts, an entity shall recognize a group of reinsurance contracts held if the reinsurance contracts held provide proportionate coverage at the beginning of the coverage period of the group of reinsurance contracts held or at the initial recognition of an underlying contract, whichever is later, and in all other cases from the beginning of the coverage period of the group of reinsurance contracts held. Compare this to the recognition rules for insurance contract which we discussed earlier. So ito naman yung insurance contracts. An entity should recognize a group of insurance contract and issues from the earliest of the following. Diba? Ito nga pinag-usapan natin, itong tatlong to, the beginning of the coverage period, the date when the first payment from a policyholder becomes due, and when the group becomes onerous. So, yan yung differences nila. Ito yung blue, yun yung kung paano i-recognize, when to recognize reinsurance, and yung the other side is for the insurance contracts, which we discuss more in detail. With regard to measurement, the requirements of PFRS 17 are also modified for the insurance contracts held. So, in estimating the present value of future expected cash flows for the insurance contract, entities use assumptions consistent with those used for related direct insurance contract. Additionally, estimates include the risk of reinsurers' non-performance. So, in estimating expected cash flows, halos pareho ang computation ng cash flows for reinsurance and insurance. Doon lang sa reinsurance, ini-include sa assumptions yung risk of non-performance nung reinsurer. For reinsurance, the risk adjustment for non-financial risk is estimated to represent the transfer of risk from the holder of the reinsurance contract to the reinsurer, whereas for insurance, the risk adjustment for non-financial risk is estimated to determine the compensation an entity requires for bearing the uncertainty about the amount and timing of future cash flows arising from non-financial risk as the entity fulfills insurance contract. So on initial recognition, the contractual service margin is determined similarly to that of direct insurance contract issued, except that the CSM represents the net gain or loss on purchasing reinsurance. On initial recognition, this net gain or loss is deferred unless the net loss relates to events that occurred before purchasing a reinsurance contract, in which case it is expensed immediately. Subsequently, reinsurance contracts held are accounted similarly to insurance contracts under the general model. Changes in reinsurer's risk of non-performance are reflected in profit or loss and do not adjust the CSM. So, in summary, halos pareho lang yung recognition and measurement rules for between reinsurance contracts and insurance contracts. Yun lang sa reinsurance, minomodify nila ng konti yung measurement rules and recognition ng insurance contracts. Therefore, ang pinaka-importante is we should know how to measure direct insurance contracts para madali na rin nating maintindihan yung pag-recognize at measure ng reinsurance contracts. Kasi ang basis ng reinsurance contracts would be yung insurance contract rules and rules then in regards to recognition and measurement. What about the recognition? When are insurance contracts derecognized? An entity shall derecognize an insurance contract when and only when it is extinguished, that is, when the obligation is specified in the insurance contract expires or is discharged or canceled, or when any of the conditions of a substantive modification of an insurance contract are met. I think yung letter A is understandable, di ba? Pag na-extinguish, kailangan i-recognize. Pero yung letter B, it says, but when is yung modification of an insurance contracts are met, nakalagay dyan, di ba? When any of the conditions of a substantive modification of an insurance contract are met. So, kailan ba nami-meet ang modification of an insurance contract? Sometimes modifications of contracts occur because, for example, changes in the terms of agreement between the parties to the contract, or baka nagkaroon ng changes sa regulations that mandated the contracts to be modified. In such cases, and as I said, if the terms of insurance contract are substantively modified, an entity should recognize the original contract and recognize the modified contract as a new contract if there is a substantive modification based on meeting any of the specified criteria. So, kailangan mo nang i-recognize yung buong original contract and then isi-set up yung new contract. So, hindi siya yung iiwan mo sa libro yung original contract and then just recognize yung mga modifications na ginawa. So, kailangan tanggalin, saka i-book yung bagong contract. So, what are the conditions that need to be met to qualify as substantive modifications to the contract? So, these are the conditions that need to be met in order for a modification to be considered substantive. If had the modified terms been included at contract's inception, this would have led to exclusion from the standard scope. So for example, baka yung modification sa insurance resulted in the contract becoming more of warranty service instead, in which case, dapat PFRS 15 na ang mag-a-apply sa kanya. Another is unbundling of different embedded derivatives. So for example, baka dati may embedded derivative na highly interrelated sa insurance contract sa coverage siya ng PFRS 17. Pero baka yung modification resulted na to the embedded derivatives, meaning na meeting the separation contract na, in which case dapat nang i-account yung distinct na embedded derivative under PFRS 9. Another is redefinition of the contract boundary. So meaning the modified contract would have had substantially different contract boundary. Meaning yung cash flows within the contract boundary na pinag-uusapan natin kanina, nag-iba na. The last one is the reallocation to a different group of contracts. So meaning naman ito is the modified contract would have been included in a different contract group. So for example, yung life, baka yung life na insurance, naging annuity from life insurance, naging annuity contract yung insurance. So that is an example of reallocation to a different group of contracts. Kasi syempre, di ba sabi natin, dapat nasa magkaibang portfolio yung dalawang yun. The next condition that has to be met to be considered substantive modification is if the original contract met the definition of a direct participation insurance contracts, but the modified contract no longer meets the definition or vice versa. So what is a direct participating insurance contract? Insurance contracts with direct participation features are insurance contracts that are substantially investment-related service contracts under which an entity promises an investment return based on underlying items. And the last condition for a substantive modification is if the entity originally applied the PAA, but the contract's modification made it no longer eligible for it. For example, baka dati short-term lang yung contract, therefore pwede siya sa PAA. Pero baka ngayon, nung minodify, naging long-term yung contract. Therefore, that is a substantive modification na dapat ma-extinguish yung original contract, meaning ma-recognize dapat ma-recognize yung original contract sa libro, saka ibubook yung bagong contract. So sa statement of financial position, dito na tayo sa presentation in the statement of financial position. Pag-usapan natin how are insurance contracts presented in the financial statement. Unahin natin yung sa statement of financial position. Under PFRS 17, an entity should present separately in the statement of financial position the carrying amount of groups of insurance contracts issued that are assets, insurance contracts issued that are liabilities, reinsurance contracts held that are assets, and reinsurance contracts held that are liabilities. So here's an excerpt of an insurance company's statement of financial position as of December 31, 2018. This is an actual financial statement. The insurance company is a publicly listed entity, so this financial report is actually available to the public. Kaya nagamit ko siyang example. As you can see here, the insurance accounts separately presented here are the insurance receivables, legal policy reserves, which pertains to the reinsurer's net share, and other insurance liabilities. The breakdown of these accounts, which include the reinsurance balances, had been presented in the related notes to the financial statements. According to PFRS 17, the aggregate carrying amount of the group of insurance and reinsurance contracts should be presented in the statement of financial position. Since this is an older copy of an entity's financial statements, I would guess that they would have to transfer the balances of the insurance contracts from the notes to financial statements to the statement of financial position in order to comply with PFRS 17 kasi required ng PFRS 17 dapat nasa statement of financial position siya. An entity, pagdating naman sa statement of income, an entity should disaggregate the amounts recognized in the statement of financial performance into an insurance service result comprising insurance revenue and insurance service expenses and insurance finance income or expenses. Income or expenses from the insurance contracts held should be presented separately from the expenses or income from insurance contracts. So, dapat hiwalay yung from sa reinsurance. From direct insurance, dapat ihiwalay yung sa reinsurance. By the way, the statement of financial performance is the term used in PFRS for statement of income. Statement of performance ang ginagamit nilang term in pertaining to, pag nagpe-pertain sila sa statement of income, ang tawag nila is statement of financial performance. So these are the disclosure requirements under PFRS 17. Marami, masyado actually. So the entity should disclose qualitative and quantitative information about the amounts recognized in its financial statements that arise from insurance contracts, the significant judgments and changes in those judgments made when applying PFRS 17, the nature and extent of the risks that arise from insurance contracts, reconciliation of opening to closing balances of the various components of the liability for remaining coverage and the liability for incurred claims, an analysis of insurance revenue, information about initial recognition of insurance contracts in the statement of financial position, marami pa, an explanation of when an entity expects to recognize the contractual service margin remaining at the end of the reporting period in profit or loss, an explanation of the total amount of insurance finance income or expenses in profit or loss, and the composition and fair value of the underlying items for contracts with direct participation features, information about the entity's approach to determining various inputs in the fulfillment cash flows, the confidence level used to determine the risk adjustment for non-financial risk, information about yield curves used to discount cash flows that do not vary based on returns from underlying items, information about the effect of the regulatory framework in which the entity operates. So, as you can see, maraming hinihingi ang PFRS, masyado. And many insurance companies are finding it really not easy to comply with these new standards sa dami ng binago nilang rules and required disclosures and presentations. So, nahihirapan ng maraming insurance companies. Kasi kailangan nilang mag-change ng system and all that para ma-meet lahat ng requirements ng PFRS 17. Kaya naman, the effectivity of this new standard, which was supposed to be effective for periods beginning January 1, 2021, so dapat actually this year nag-start na siya, has now been extended to January 1, 2023. And when it becomes effective, an entity should apply the standard retrospectively unless impracticable. PFRS 17 provided naman discussions on what to do when the entity finds it impracticable to effect the standard retrospectively. Actually, meron siyang approaches or meron siyang mga procedures na kailangan gawin nung insurance company kung hindi nila kayang i-recognize or i-adopt yung standard retrospectively. And pag binasa ninyo yung standard, medyo hindi rin ganun kadali pag hindi kadaling i-adopt yung parang alternative way nila kapag hindi ka pwedeng mag-apply retrospectively. Kasi parang hindi ganun. Basically, pag hindi ka nag-apply retrospectively, merong ipapagawa sa'yo yung standard na medyo marami din. So, I don't know kung mas gugustuhin ng mga insurance company not to apply retrospectively. But in any case, hirap sila. Yun ang basic summary ng PFRS 17. Hirap, maraming nahirapan to comply with all the requirements of this new standard for insurance companies. So, as I said, talagang super complicated especially sa mga walang insurance background, ang PFRS 17. And since bagong-bago pa siya, I really encourage you to study this standard, lalo na kung magkakaroon kayo ng client na may insurance business. So, medyo mahaba siya, medyo mahirap maintindihan. Sabi ko nga, if you don't have any insurance background. Pero pwede naman siya, siguro kailangan lang ng medyo mas matagal na pag-upo and pagbasa nung standard para mai-apply niyo siya kapag nagkaroon kayo ng insurance client. And anyway, effective pa naman ito by January 1, 2023. So, ang magpe-prevail pa ring PFRS would be yung insurance contracts na PFRS, yung current na insurance contracts na PFRS. Actually, that's it. Alam kong complicated siya, so hopefully meron kayong natutuhan kahit paano because hindi nga siya ganun kadaling maintindihan. Okay, thank you very much.